Assalamu alaikum. Introduce myself. My name is Putri Veronica from Management 22A. My NPM is 22,411,040. Cognitive bias in accounting decisions. Cognitive bias refers to the systematic patterns of deviation from norm or rationality in judgment, which often lead to perceptual distortion, inaccurate judgments, or illogical interpretations. In the field of accounting, where precision, objectivity, and rational decision-making are expected, the presence of cognitive biases can significantly influence the quality of decisions made by accountants, auditors, financial analysts, and managers. These biases may arise subconsciously and can affect financial reporting, budgeting, forecasting, auditing, and strategic planning. One of the most prevalent cognitive biases in accounting is the confirmation bias. This occurs when individuals selectively gather or interpret information that confirms their pre-existing beliefs while ignoring contradictory evidence. For instance, an accountant reviewing financial trends may unconsciously highlight data that supports a positive outcome while downplaying warning signs. This can lead to flawed investment decisions or misleading financial forecasts, especially when pressure exists to meet stakeholder expectations. Another common bias is the anchoring bias, where decision-makers rely too heavily on the first piece of information they receive, the anchor, when making judgments. In accounting, this could manifest during budgeting or valuation processes. For example, if last year's revenue is used as a baseline, accountants may fail to adjust sufficiently for significant changes in the business environment, leading to inaccurate budgets or forecasts. Anchoring can also impact asset valuation, where the first suggested value may disproportionately influence the final number. The availability heuristic. Another bias affects how accountants assess the likelihood of future events based on the ease with which examples come to mind. If an auditor recently encountered a case of fraud, they might overestimate the likelihood of fraud in other audits, potentially leading to unnecessary scrutiny or misallocation of audit resources. Conversely, if fraud is rare in their experience, they may underestimate its risk, compromising the thoroughness of their audit procedures. Overconfidence bias is also prevalent among accounting professionals, particularly in financial analysts and auditors. This bias leads individuals to overestimate their knowledge, judgment, or predictive abilities. An overconfident accountant may overlook important risk indicators or assume that their interpretations of complex standards are unquestionably correct. In auditing, overconfidence can result in reduced skepticism, less rigorous testing, and a higher risk of audit failure. Hindsight bias involves the tendency to believe, after an event has occurred, that the outcome was predictable all along. I think enough. Thanks for your attention and see you.
Small doses can sometimes be motivating. However, chronic